Buying term insurance is one of the most important financial decisions you can make for your family. If you pass away, your term plan pays out. That is what it is designed to do, and it does it well. But there is a scenario that term insurance is not designed for, and it comes up far more often than most buyers realize. Suppose you survive a serious illness, cancer, a major heart attack, or a stroke. You take a break from work, you recover, but your income might pause. Yet EMIs keep running. Your family has to manage both the recovery and the finances at the same time. A standard term insurance plan is primarily designed to provide a payout in case of death and may not provide coverage for income loss arising due to critical illness unless relevant riders or benefit are opted for. So in this video, we are actually going to cover exactly what critical illness cover is, how it works alongside your term plan, what conditions are covered, and whether you actually need it. By the end, you will know whether there is a gap in your current protection and what to do about it. Let us start with exactly how the product works because there is a lot of confusion here. A critical illness cover or rider pays you a lump sum when you are diagnosed with a condition on the policy's covered list and you survive 30 days from the date of diagnosis. The 30-day survival period is the standard conditions across most CI policies in India. Once that is met, the insurer pays the full cover amount directly to you. Critical illness cover is available in two forms. The first is a standalone plan, which you buy on its own. The second is as a rider, which means an add-on you attach to your existing life insurance policy for additional premium. This is not a reimbursement. You do not submit hospital bills. You do not wait for treatment approval. You receive the money. And what you do with it is entirely your decision. You can use it for treatment, for household expenses, to keep up your EMI payments, to fund your family while you recover, or for anything else you need. Your term insurance pays your family if you pass away. Your health insurance reimburses your treatment and hospitalization costs when you are ill or injured. Your critical illness cover pays you a lump sum on diagnosis of a specified serious illness. All three cover different things. None of them replaces the other. The part that matters most for people who already have a term plan, if you have a CI rider on your term policy and you make a CI claim, your base term insurance policy remains completely intact. The coverage amount your family is protected by does not change. In certain products, the base term insurance cover may continue after a critical illness claim, subject to product terms and conditions. The CI payouts separate. Your term plan continues as though nothing happened. The continuation of the base policy shall be governed by the applicable product terms and conditions. Certain commonly covered critical illnesses are defined under applicable IRDAI regulations guidelines. The illnesses covered may vary by insurer and product. Insurers can and often do cover additional conditions on top of this, but the core list is consistent across the industry. According to the IRDAI health insurance regulations, commonly covered conditions under many critical illness policies may include cancer of specified severity, heart attack of specified severity, stroke that results in permanent symptoms, kidney failure requiring regular dialysis, major organ transplant covering heart, lung, liver, kidney and pancreas, coronary artery bypass surgery, aorta graft surgery, heart valve replacement or repair, and paralysis of limbs. To give you a sense of how common these conditions are in India, the ICMR National Cancer Registry 2023, published by the Indian Council of Medical Research, recorded approximately 14 lakh new cancer cases in India that year. That is, cancer alone, heart attacks, strokes, and kidney failure together affect hundreds of thousands of more Indians every year. And treatment outcomes have improved significantly. Surviving a critical illness is now the more likely outcome in many cases. The financial challenge that survival creates is exactly what CI cover is designed to address. Beyond the core list, many comprehensive CI policies cover 20 or more conditions. When you are evaluating any CI cover, check three things: the specific list of conditions covered, the severity level required to trigger the payout for each condition, and whether the conditions you have a personal or family history concern about are on the list. Two standard features apply across all CI policies and are worth knowing upfront. Most CI policies have a waiting period of 90 days from the start of the policy, during which a new diagnosis will not trigger the payout. Pre-existing conditions diagnosed within 36 months before the policy starts are typically excluded. Reading your policy document for the exact definition is worth the time before you buy. There are two ways to get critical illness cover in India. You can add a CI rider to your existing term insurance plan, or you can buy a standalone critical illness policy separately. Here is how to think about which one fits your situation. A CI rider is added to your term plan at the point of purchase for an additional premium. It covers a defined list of conditions, typically fewer than a standalone policy. The sum assured under the rider is separate from your base term cover. If you are ever diagnosed with a covered condition that fulfill the survival period condition, the rider pays out the full amount to you as a lump sum. Your base term plan continues with its full cover amount unchanged. The rider terminates after a CI claim, but your term cover stays active. The rider is a simpler and lower cost option for most buyers whose primary goal is protection during recovery and a clean add-on to their existing term protection. The rider works well. The premium addition is typically modest. Under Section 11, read with Schedule 2, previously Section 10(10)(d), the premium paid for a CI rider is eligible for a tax deduction as a health-related insurance expense. A standalone CI policy is brought independently of your life insurance. It typically covers more conditions, allows a higher cover amount, and is available even if your term plan does not offer a CI rider option. It is a right choice if you want critical illness protection as a dedicated product with broader coverage, rather than as a supplement to your term plan. The practical question to ask yourself whether if your income stopped for 12 to 18 months during a recovery, could your family manage financially? If the honest answer is that things would get difficult, a CI rider is a straightforward and affordable way to cover that gap. For most salaried buyers with dependents and a home loan, it is one of the most practically useful riders to evaluate when setting up or reviewing a term plan. Everything we covered today comes down to 3 questions most people ask before they decide on this. Let me answer each one directly. What is critical illness cover and how is it different from health insurance? Critical illness cover pays a fixed lump sum directly to you when you are diagnosed with a specified serious illness and survive 30 days from diagnosis. Health insurance reimburses the treatment and hospitalization costs. The difference that matters is income. Health insurance covers what the hospital bills. Critical illness covers what the illness costs your life, including the months of income you lose while recovering. You need both because they cover different things. What conditions are covered under critical illness policy in India? IRDAI defines a list of critical illness that is covered in most of the CI policies in India. This includes cancer, heart attack, stroke with permanent symptoms, kidney failure, major organ transplant, coronary artery bypass surgery, heart valve surgery, aorta graft surgery, and paralysis of limbs. Many standalone CI policies extend this to 20 or more conditions. The severity level required to trigger the payout varies by condition and insurer. So reviewing the definitions in your specific policy document before purchasing is important. Is it worth adding a critical illness rider to a term insurance plan in India? For most buyers with dependents and an active home loan, yes. The CI rider covers the financial gap that term insurance cannot. The period when you are alive but unable to work due to a serious illness, the premium addition is typically modest. The payout is a lump sum you can use without restriction, and the premium qualifies for a deduction under Section 11, read with Schedule 2, previously Section 10 and 10(d), Income Tax Act. ABSLI's term plans include CI riders option that keeps the base cover fully intact after CI claim. If you have a term plan and no CI cover yet, the description below has ABSLI's options. You can see the rider details and add CI cover to your plan directly. Adding it now, while you are in a good health, is when the cost is lowest and the cover is simplest to get in place. Like and subscribe if this was useful. New videos every week.